Hey everyone, so we are going to start digging into the other famous financial statement called the balance sheet. This report, I'm going to go over what it consists of and then how to understand what it means. So first we have, I want to go ahead and run this as last fiscal year. Like I explained in the previous videos, there is accrual basis right here and there's cash basis. But because we're entering everything as it has already hit the bank, even if I switch this to cash basis, it's going to have the same numbers. But if you happen to have a business with accounts receivable or accounts payable, cash and accrual will change. So keep that in mind when you're running reports, if you're using accounts receivable and accounts payable inside of QuickBooks. Okay, so this first section right here is all assets. So assets are things that you own. So clearly this company uses profit first method. That's why they have so many bank accounts. Normally we label those to match the profit first method. So that would be like OPEX, owner's comp, taxes, and profit. And then the income or sales, where all the money comes in to be dispersed. Normally we label that. But it really isn't extremely important inside of QuickBooks, but it's also helpful for the client to see it. So we normally label that on here. So these are assets. So cash you own, obviously. Cash deposits in transit. So that's cash that you've earned. You have not hit, it hasn't hit the bank. So either you took it home or it's sitting in your cash register. That's all that could be. Deposit in transit is also money that you've earned that just hasn't hit the bank yet. So maybe some sales that, in this instance, that were sold on December 30th or December 31st that hit the bank on January 1st, 2nd, or 3rd. Those would be recorded there. And then, like I said, all the checkings. And then payroll clearing account is more of an accounting, it's more of an accounting thing. It's a way to record payroll after the fact. So you might have a payroll company that you enter the entries for, but you don't have time to break them down into like salaries and wages, employer payroll tax expense, all that. So you put them there, and then when you have the breakdown, you put it in there, and it's supposed to zero out. So the fact this has a balance means it's not good, and that should be investigated. So if you ever have any kind of clearing account, they should always be zero. And if they're not zero, you have to figure it out. It's like a litmus test to see if something is accurate. There also is another litmus test on here. So cash, DIT, if you were to look at that and say, there's no way I have $2,300 in my cash register, then you either have some of the following things wrong. Potential employee theft. You forgot to record all the stuff you purchased with cash. So say you paid a window washer. Let's look at what that would look like. So we'd write a check out of the bank account of cash. Window, oh, right there, window cleaners. See, a lot of brick and mortars have window cleaners. I paid them $20 out of cash. That is how you record it. That's what it should look like, guys. So that way you're getting credit for the expense and the money's hitting cash. Now, that number did not change because I dated it today's date. So if I wanted to not date it today's date so you could see it reflect, that would have been smart, huh? 12. Okay, see, this just loaded by $20. So that gives you the opportunity, setting up your cash register this way, gives you the opportunity to write a check or an expense for anything you paid with cash. Now, I recommend you don't do this. I highly recommend that every day, or if you have employees, do it every day. If you don't have employees and just you, no less than once a week, I would say. Take all your cash to the bank. If you don't, basically consider it gone forever, and you're going to have to eat that as a member straw, and it won't be a write-off. So be very diligent. But like I said, especially if you have employees, if human nature will kick in, I've heard people so shocked that their employees stole from them, and of course you're only going to hire people who you think are honest, but it still happens. So you definitely want a reconciliation process to every day you're taking that cash to the bank and it matches exactly what your point of sale said you should have had in cash that day. So don't forget to make that a process, or you're going to end up with a lot of cash on hand at the end of the year, and you're going to either have to A, come up with expense, or B, eat it as an owner's draw. So not fun. Another litmus test is if your deposit in transit is more than a whole month of sales, then you need to look into it. You're missing deposits. So if that number, so this particular sample boutique, let's make this smaller. This sample boutique made $19,000 in December and had $1,800 left. $19,000 in December and had $1,800 left. That's good. But what if my deposit in transit said $36,000 and she only made $19,000 in the month of December? We have a problem. So either our sales are overstated or missing deposits. Now in the past we've seen where there was another checking account that we didn't know about that the client forgot to tell us about, and we were able to find those missing deposits, or for whatever reason they had to connect their Shopify to a personal account. This is how we find that kind of information. But you should see a pattern for deposit in transit to see that every month is the same, and you can actually see what it says columns. You can actually say by month, and then you can see what's normal. Like, wow, it was really big there, but it went back down, so she must have had a lot of sales at the end of that month. But if it went from $325 to $11,000 and then stayed at $11,000, I would say there's definitely a problem in May. But see, it's pretty standard. It's a little high in November, but we can expect that because of Black Friday, and then it went back down to normal. But again, if it didn't go back down to normal, I would question it. So that is, looking at it by month will tell you if it's normal. All right, so we're moving down to inventory asset. We briefly touched on this in previous videos, but again, this should only be containing either yearly or monthly adjustments. So let me move my thing down. So this looks like this client went from 2018 to a once a year entry, 2019 once a year entry, and then is starting a monthly entry starting 2020. I recommend that you do the monthly entry to make your balance sheet match, make this number right here match at the end of every month what you actually had on hand, the value of it, not the retail, but the wholesale, what you purchased it for, so that you don't get surprised come tax time. I've seen literally $30,000 swings come from the net to the net income through this exact thing. So remember, inventory asset is what you had on hand at the end of every month. It can be a guesstimate. A guesstimate is better than nothing. Nothing is not going to be beneficial to you. So just keep that in mind. If you have any questions, I know that's a little bit tricky. I recommend you get like either a third-party app, or you could just utilize what Shopify already has built in. Already has built into their software, and just run the numbers. So basically, and I'm just revisiting just in case somebody missed it in the last video. But if you in Shopify, lost my connection for a second. If you in Shopify enter your cost per item, not including inbound shipping, in Shopify, you can run a report. You have to pull it on the first day of the month, of course, or the end of the day on the last day of the month. And you can pull, say, what is my on-hand inventory? It'll tell you the quantity in hand, the cost of it, and then you can do the math in Excel. You know, do a simple equation: quantity times cost equals, and then that'll be the value of that. You do it for all your items. You copy you pull the copy formula button, pull it down, and then summarize it at the bottom, and you got yourself your on-hand inventory as of at the end of the previous month. So that's already built in. It's already free. Sure, you have to know a little bit about Excel. That part about Excel is really easy to learn. And if enough of you reach out asking for help, I will definitely do a video on that. It's very easy once you see it done once. But I recommend you do it monthly. If I can't stress that enough, do it monthly. All right, the last asset we have here on this sample balance sheet is security deposit asset. So a lot of people think when they start to rent a warehouse or a storefront that their deposit is an expense, but it's actually an asset because you can get it refunded. I know a lot of landlords don't necessarily refund that, but it's an asset until it's officially expense. So some other similar assets that other boutiques might have are if you have any computers. Computers over, I would say, $500 should definitely be depreciated and put on here as an asset. Company vehicles. If you have a mobile boutique or a trailer, it would go on here. Now, if you bought like something like this, some kind of wall thing, you know, really cute and stylish, but it only cost $50 or, you know, not a whole lot, that would be an expense. It would go under either your decor and fixtures or just job supplies. So you wouldn't make that an asset. So it really goes on the cost per item. If you bought a really expensive camera to do shoots with or to take pictures of your clothing with, that would be an asset. Generally, the asset limit is around $500, or the minimum is $500. So vehicles, expensive assets purchased. If you buy a franchise or an intangible asset, that would go on your balance sheet. So, you know, when franchisees pay in to be a part of a franchise and they spend, like, say, $30,000, that would be an intangible asset. And then the last one I'll hit that will actually hit most of you pretty close to home, especially if you have a brick and mortar, are leasehold improvements. So if you go into a new space and you have to spend $15,000 getting it brought up to speed to make it look pretty and nice, that $15,000 is not immediate expense. It would go to an other asset called leasehold improvement. You would put everything you spent, even if it's $15 here or there, to that asset, and then your CPA or whoever prepares your taxes will write that off over X amount of years, whatever the IRS says is necessary. Now, sometimes we'll get a depreciation holiday where we can 100% depreciate stuff, but then you want to do that. Obviously your tax preparer will be the one that makes that decision for you or with you. But the benefit to that is you don't have to do that. So if it doesn't, like, if your net income's already negative, you don't want to I would rather wait to depreciate that $15,000 to a year where I actually have income and then depreciate it. So that's something to think about. I did think of one more off the top of my head. Employee loans. If you ever given a loan to your employee or to another business, it would be an other current asset on here. So employee loans. But so we have went over all the assets. Next time we'll hit up liabilities and equity accounts, and that will complete your balance sheet. So thank you so much for watching, and I look forward to spending time with you next session.